we have in our conference room a number of slogans that are on the crown molding around the room. And the first one you see says the bottom line of all investing is rate of return. And we believe that's in our DNA. And so everything we do about selecting an investment goes to the issue about how can we best understand what the rate of return opportunity is in that investment. We believe that whatever return the business has itself will be reflected in the share price over a period of time. We do some simple little arithmetic to reinforce that. Then when we find a business, we really focus on three issues, and in the shorthand, we've all talked about that, called the three-legged stool. Mm-hmm. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time, if the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record and whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. Mm-hmm. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect. And that's what we're after at the end of the day. We want to compound our shareholders, our clients' capital at an above average rate while assuming a below average level of risk. And the below average level of risk piece for us has got nothing to do with volatility. It has to do with the fact that the businesses we own on average have more returns on capital, have higher growth rates, have stronger balance sheets, and very frequently have lower valuations than the market at the time we purchased them. So on their face, they have less risk than the market, than average. So,
John, listening to Chuck, you joined Akre Capital Management 10 years ago, and as an analyst, and then you became a portfolio manager several years later, big transition. You describe yourself as a true believer in this approach. What is it that attracted you to Akre Capital Management?
It was several things. And the interesting thing about the philosophy and what Chuck has practiced and preached all these years is that there's a real integrity to it. And what I mean by that is that one thing follows naturally from the next. So the first thing is that, as he likes to say, we aren't speculators in the price movement of shares. We own businesses. And the focus is on owning the most exceptional businesses that we can find. And if you're really limiting yourself to exceptional businesses, the list of businesses that you would ever own is going to be a short list. And that's why we're incredibly concentrated. And if you've identified a great business and you've purchased it well, why would you be in a rush to sell it? So the turnover is very low. We're not trading in and out of these names. And sort of lastly, it was very clear to me that Chuck didn't operate under a lot of these sort of institutional imperatives that a lot of money managers do in terms of diversification, in terms of willingness to hold cash. So in fact, I actually, before submitting my resume, watched an interview that Chuck did on television. I think it was in 2008. And he said at the time, I believe he was 35% cash. And whether being 35% cash was a good thing or not, what it said to me very clearly is that here's somebody who thinks and operates independently. So I found that very attractive.
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on, and oftentimes it is not completely obvious as to what it is that's going on A great example of that would be a company like MasterCard or Visa. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
Okay.
It's just that simple, you know. And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates. So what they do with their free cash flow is they buy in shares, they pay a cash dividend, they make small acquisitions in technology around their space, but it's a challenge to utilize all the free cash they generate. And unlike our ideal company is one that can keep reinvesting and earn outrageous returns on capital.
Right. One of the things, John, part of the interview process was that you had to submit a stock idea to Chuck.
Right.
And so you submitted a stock idea to Chuck, and he rejected it, and he hired you anyhow. What was the stock idea, and why, Chuck, did you reject it? Stock idea first. What happened?
Sure. So it was the summer of 2009, and I was interviewing, and naturally we're talking about ideas. And the primary idea I was pitching to Chuck at the time was Moody's Corporation, which is best known as one of the two dominant credit rating agencies in the world.
And had a stellar reputation after the financial crisis, and
Well,
right?
in the wake of the financial crisis and during the financial crisis, Moody's actually was one of the poster children for what went wrong. They were roundly blamed for the financial crisis, and because the ratings were wrong on anything that was related to residential mortgage-backed securities. What I maintained in pitching the idea to Chuck was that while I wouldn't defend the outcome of any of the ratings or the accuracy of the ratings in any way, shape, or form, what I did believe was that the problem was upstream from the rating agencies in terms of that the problem really started with the banks that securitized these products and then misrepresented what was actually in these pools of securities. And that Moody's was taking the blame, but that in fact, that's actually one of the roles that Moody's serves in the debt capital markets, is scapegoat periodically, that the franchise would remain intact. Well, back to our three-legged stool, business, people, reinvestment, Chuck rejected the idea on the grounds that the people had to have been behaving very poorly. What we sort of shelved the idea. He hired me anyway. The stock was around $16 a share in the summer of 2009. A couple years later, it was in the low 30s. And I said, and it was still dirt cheap. And I said to Chuck, look, I can talk till I'm blue in the face, but your problem here is with the people, so let's go see the people. So we came up to see the management team of Moody's. I asked most of the questions.
And I might tell our audience that it's like one of your largest holdings, so just so they know that right up front. Yep. Okay.
And I asked most of the questions. Chuck listened. Chuck lobbed in a question periodically, and we went back to the office. And soon thereafter, we started buying the shares, and it was a wonderful lesson for me. Here I am brand new and working with Chuck, but it was a tremendous lesson that I will never forget. And the lesson was that he could have said, well, I'm Chuck Akre, I've been doing this a long time. I have spoken, and the answer is no. When he was presented with a good case, he changed his mind.
Right.
And that is a tremendously valuable thing to be able to do in our business. You have to do it to be a successful investor. And he showed me in those early days that he was able to do that, and that really impressed me.
Right. They must have made a great case for themselves, management at Moody's. So why did you decide that that's going to be one of your rare and largest holdings?
So what I first said to John was, their behavior during the housing crisis was deplorable.
Yeah.
And what I came to believe was that the people were honorable people, had used bad judgment, but they were honorable people.
Okay.
And that was really the change, because the business itself was a terrific business. We've added to the position over the years and been hugely successful. So,
When you consider Chuck's approach, just tell me what it is that you believe in.
I think at the end of the day, what it comes down to is a really firm qualitative understanding of what makes a business great. We can't screen quantitatively for what it is we're looking for.
Right.
If we could, this would be easy. If we could, then the algorithms and the quants could find what we find. So our understanding is invariably qualitative. If we have an edge, that's where it exists.
and we also understand that nothing is forever, and and great business models today may not be in the future. So what we bring to the whole process is judgment, and we have this saying that good judgment comes from experience, and experience comes from bad judgment. And it's true. It cannot be, to the best of our knowledge, it cannot be substituted for by code and an algorithm and that what sort of stuff. That we are unlikely to be supplanted by somebody's black box. Because it is not strictly a matter of quantitative mathematics.
Did you ever try to convince Chuck to invest in any of the FAANGs?
No.
No.
I never have.
And
you'd asked before what makes these businesses
Yeah.
so hard to find.
Yes.
And one of the things that makes them hard to find, even if we have a sense that there may be something exceptional happening at the business might be great.
Right.
We're also limited by our ability to understand the companies. So that also tends to shrink the number of potential
Right.
investments that we can make.
Amazon, you could understand as it morphed into buying everything,
Right.
but still, was difficulty because it wasn't showing a profit and that sort of. You could figure out what the cash flow was and how they were growing the business. So we can't dance all the dances, and those things by and large it was not in our wheelhouse for the most part.
Right.
Yeah, I just would say that. Yeah.
Let's talk about one company that's your top holding at the moment, at any rate, which is American Tower, which you've held for a long time.
Right.
And that's a tower company.
Right.
Right. So explain what it is about American Tower.
Today, it is the largest tower company in the world. Operates in 16 countries outside the U.S. approximately. If you want growth in wireless communications, it is deployed through a system of antennas, and the antennas are primarily on towers. So the tower companies really sort of own that toll booth today in the growth of wireless, as we've experienced 1G, 2G, 3G, 4G to less an extent, 5G that everybody's talking about now. Each of those requires a denser network of antenna to, among other things, to increase the likelihood of uninterrupted communications between the devices and whatnot. So American Tower and Crown Castle and some others sit in that space, and it's a very desirable space. And the way you see that, when I talked about rates of returns at the outset, the rate of return on an incremental antenna at American Tower, once they get to break even, the incremental turn is probably north of 90%, and which is a very powerful business model.
So one of the things that's happened at Akre Capital Management since you've been there, John, is that the assets under management have really grown. So when I talked to Chuck in, I think it was 2014, the assets under management were $3 billion. They're now 12 or 13 billion,
right, yeah.
exactly. And there's this research that shows that smaller money managers can really do well, but when they get more money, they can't really deploy it well, and therefore they don't do as well in the future. You've avoided that so far. So how do you think you're avoiding that kind of investment rule?
Before he answers, I'll say I'm not sure we are avoiding it. Now,
and the other part of my question should be, when I talked to you in 2014 that you had 30 holdings, you're now down to 17. You've got a ton more money. Shouldn't you have more holdings? So go ahead.
Right. So we always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that deviates positively or negatively from average. And I think
so you're flipping coins, Chuck. You didn't know that. But okay.
So,
Okay.
but that's what I mean by
So that's the philosophy.
So it's really not about our AUM. It's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
In 2014, if we had 30 or 35 holdings, we would have been at that point in time less confident in those names than we are in the 17 holdings today.
Okay.
So if you see our holdings go to 35 again, you should just understand that it means we are less confident in the characteristics of the group as a whole, and that's why we have it spread out. And then the concentration, pure concentration, is we want to have as much money invested in the great businesses as we possibly can, because our return will come from their good experience. We will be riding on the back of those great businesses. So that's why we want to have all this, our capital concentrated in those things. Then lastly, the law of large numbers. It stands to reason, and we've already experienced it, that small businesses can't have much of an impact on a $12 billion portfolio.
Right.
So we don't have small companies in the fund any longer.
Oh, you don't?
We don't. I mean, because they don't add value, and so we run into that a little bit, as you would expect.
So what interesting is that you had told me over the phone that you don't have, that another differentiator is you don't have sell targets.
Correct.
At Akre.
That's huge.
So if we've identified a great business, a compounding machine that we've purchased well, we want not to interrupt that compounding unnecessarily by curtailing it with a sell target. We want these businesses to continue to compound, and we want to own them as long as they continue to be exceptional. So no sell targets, only buy targets.
Which actually goes to my next question to Chuck, is that when we're talking about kind of the next 30 years or 40 years or 50 years of Akre Capital Management, and you told me that the process has to be logical, understandable, and repeatable.
Yes, and we think the evidence fully supports that. It is logical when we talk about the simplicity of the process, understanding these great businesses and the high returns. It is logical that your returns come from the experience of the businesses, and it's repeatable because we've now been doing it in the Focus Fund for 10 years and in our firm overall for 30 years,
right?
Continuing to have above average outcomes, and so I rest my case. I mean,
And as a true believer, have you had any moments of doubt about that approach, John?
None. The test for that is always in a market downturn.
Yes,
because
which
the
you haven't
temptation-
experienced at Akre yet.
Not in a protracted way. We haven't had a bear market, but we've had some tougher. We've had some tough years in the market generally, and less good returns generally in certain years. But no, we haven't had a full-fledged bear market.
You look at 2018,
Right.
where the market gave up all of its return in the fourth quarter, and it was down roughly 4% on the year, but our fund was up 4% on the year.
So your companies protected you.
Our companies protected us.
Below
right?
average risk.
It was not because we were clever at buying and selling, stocks during the daytime.
Right. One investment for a long-term diversified portfolio.
Yeah, I would probably choose MasterCard. It's such an extraordinary business, MasterCard and Visa, that is in the business of the electronic exchange of value. and view the credit card itself as what they call a form factor that doesn't really have great relevance long term. It's just how you access the rails that complete transactions around the world. There are lots of things going on in electronic exchange of value around the world. They have a front row seat in terms of their investments in technology and so on. They and others are bringing to bear on the whole issue of secure payment for transactions, exchange of value.
John?
Well, I like to say just another word about MasterCard. I like to sometimes say that the way I think of MasterCard is that whatever you buy, wherever you buy it, whether you buy it online, whether you go into a store to buy it, with MasterCard, we own a business that has secularly improving odds of being involved in that purchase transaction and thereby profiting. That's a pretty exciting business.